Let me walk you through some real, gritty stories from my years in the finance world. The kind of behind-the-scenes stuff that most folks don't talk about. We're going to peel back the layers on why the stock market seems like a slow grind, especially if you're not rolling in cash to start with. All right, let me take you back to the early days of my career. I was fresh out of college, bright-eyed, and thinking I'm going to make it big in investment banking. Like a typical finance rookie. I had stars in my eyes. So I land this gig at a big name firm, right? My first day on the job, I'm surrounded by these guys who've been in the game for decades. Real old school Wall Street types. And I'm thinking, wow, I'm about to learn from the best. But first meeting I sit in on, I start realizing something's a little off. They're talking about portfolios and how to optimize them, but it's not about maximizing returns for the clients. Nah, it's all about appearances. See, they're all about this thing called window dressing. Now, if you haven't heard of it, let me explain. Window dressing is basically when fund managers buy up flashy stocks just before the end of the quarter to make their portfolios look good on paper. Imagine sprucing up a junk car just to sell it. It looks shiny, but the engine's still shot. Ha! It's not about real value. It's about making sure the quarterly report looks solid so the clients stay happy and, more importantly, keep their money invested with us. I'm sitting there taking notes and I'm like, is this really how it works? And the kicker? It doesn't actually improve returns in any meaningful way. It's a complete facade, but it keeps the clients from asking too many questions. I remember asking one of the senior guys, so doesn't this kind of, mislead the clients? And he just chuckles, looks me dead in the eye, and says, kid, they're paying for peace of mind, not the truth. Heh, welcome to Wall Street, right? All right, now let's fast forward a bit to when I got into trading. This is where it gets really juicy. I was on a trading desk, and let me tell you, the pace is insane. You're watching these stocks move by the second, and you're making decisions in the blink of an eye. But then I noticed these guys in the corner with these giant server racks. I mean, it looked like a scene out of a sci-fi movie. I ask around, and turns out they're running high-frequency trading algorithms. These things are buying and selling stocks in milliseconds, literally faster than you can blink. Now here's the dirty part. These algorithms, they can actually see your trades before they hit the market. Imagine you're trying to buy a stock at $50, and these guys' servers swoop in, buy it for $49.99, and then flip it to you at $50.01. It's legal, but it's a total hustle. They're skimming off pennies on every trade. But when you're doing millions of trades, those pennies add up to serious cash. I'm watching this and thinking, so the little guy doesn't even have a chance here? Haha, yeah, no kidding. It's like trying to race a Ferrari in a beat-up old bike. You're not going to win. But here's the real kicker. These firms pay for co-location, which means their servers are literally sitting next to the exchange's servers. That tiny distance cuts down on the time it takes for their trades to execute. We're talking nanoseconds here. Ridiculous, right? But in this game, every nanosecond counts. The whole thing is set up so that if you're not in the know or don't have millions to spend on tech, you're already a step behind. I remember one time, we had a big institutional client who wanted to make a huge buy. We placed the order, and before it even fully executed, the price had jumped because these high-frequency guys had gotten in front of us. The client's like, what the hell happened to the price? And all I could say was, oh, well, market moves fast. But inside, I'm thinking, man, this whole game is rigged from the start. I mean, how do you explain to someone that they lost money before they even got in the game? It's funny in a sad way. I'm sitting there in my fancy suit at this big fancy firm, and I'm realizing it's not about who's smartest or who works hardest. It's about who's got the edge. And often that edge is borderline cheating, but it's all legal. Or at least legal enough, each. And let's not even get started on dark pools. Those are the private exchanges where the big players make their trades away from the public eye. So I had this buddy who worked at one of these places, and the stuff he'd tell me, oh boy, they're trading millions of shares without any public reporting until the trades are complete. It's like playing a game of poker where your opponent can see your cards, but you've got no clue what they're holding. By the time the average investor reacts, the price has already shifted because these guys made their moves behind the scenes. One day, I was chatting with him and he goes, we moved like 10 million shares of this stock today and no one's going to see it until tomorrow. And I'm just shaking my head thinking, so the average investor doesn't even stand a chance to react. It's almost like you're running a race and everyone else has already crossed the finish line before the gun goes off for you. So after that whole eye-opener with high-frequency trading and dark pools, I started digging deeper into the real mechanics of the financial world. And let me tell you, once you see how the sausage is made, you can't unsee it. One day, I'm working with this fund manager. Let's call him Mike. Now, Mike was one of those guys who's been in the game forever. Slick, polished, always with a perfectly pressed suit. And his fund? Big, actively managed, and supposedly full of expertise. You'd think this guy had a crystal ball or something with how he talked up his strategies. But here's where it gets wild. Mike's fund was basically a textbook example of what we call closet indexing. So this fund was charging a premium fee for active management. I'm talking, like 1 to 2% fees, which doesn't sound like much, but over time, that's a small fortune. And you'd think, okay, I'm paying extra, so these guys must be doing something special, right? Wrong. I started noticing that 90% of the stocks in Mike's portfolio were just mirroring the S&P 500. Yeah, they were basically hugging the index and charging a whole lot more for it. So one day, I asked Mike straight up, why are we charging clients so much if we're just tracking the index? And he looks at me with this smug smile and says, we're not selling performance, kid. We're selling confidence. Like that makes it any better. Basically, they were banking on clients not digging too deep, not realizing they could get the same thing for a fraction of the cost with a plain old index fund. It's like paying for a Rolls Royce and getting a Prius with a fancy paint job. Sure, it'll get you from A to B, but you're not exactly turning heads doing it. I remember this one time. A client came in, a sharp guy, but not someone who had the time to babysit his investments. He asks Mike, so what am I paying for here? I'm not seeing the returns I expected. And Mike, cool as a cucumber, goes into this whole spiel about market conditions, volatility, yada yada. But I'm sitting there, biting my tongue, wanting to say, you're paying for nothing, pal. You could drop your fees by 80% and get the same results. It was a real wake-up call for me, because I realized just how much of this industry is built on keeping clients comfortable rather than actually making them money. Now, let's talk insider trading, because oh boy, this one's the big elephant in the room. I was at this networking event once, rubbing elbows with all sorts of execs and insiders. It was all champagne, small talk, and the usual finance schmoozing. I'm standing there and I overhear this conversation between two guys from a pharmaceutical company. They're talking about some upcoming drug approval. And one of them says, yeah, we're expecting the FDA to greenlight it next week. You should see a nice bump in the stock. I'm just sipping my drink thinking, did that guy just drop insider info right in front of me? And look, it's not like the movies where people are handing over briefcases full of cash in some parking garage. No, it's way more casual. Little tips, whispers at parties, offhand comments that end up making someone a small fortune. And the funny part? It's all happening in plain sight. These guys just assume no one's going to call them on it. Meanwhile, regular folks like you and me, we're playing by the book, watching CNBC, trying to make sense of the market based on old news. I mean, it's almost comical if it weren't so damn frustrating. I even had a buddy who worked at an options trading desk, and he told me flat out, dude, half the orders we see, someone knows something. It's not always illegal. Sometimes it's just, very conveniently timed. Like all of a sudden, there's a surge in options volume on a stock. And a day later, boom, big news drops. You think that's just coincidence? Yeah, right. It's like showing up to a party and realizing everyone else knew the theme except you. And the SEC? Sure, they catch a few, but there's so much that slips through the cracks. All right, let's shift gears for a second and talk about analyst recommendations. Now, when I was still green in this industry, I thought these analysts were, like the prophets of Wall Street. They had all the data, all the models, and surely they must know what they're talking about, right? Ha, if only. What I found out pretty quick is that these analysts are, more like salespeople in disguise. They're on the sell side, which means their main job is to generate business for their firms, not to give you the golden ticket to riches. One time I'm sitting in on a call where an analyst is pushing this stock. Let's call it XYZ Corp. He's hyping it up like it's the next big thing, saying it's a strong buy with like a 20% upside. I'm looking at the numbers and they just don't add up. So after the call, I ask him, why are we pushing this so hard? Their earnings are flat, debt's through the roof, and the product line is outdated. He just shrugs and says, yeah, but we're underwriting their next stock offering. Got to keep the client happy. I'm just sitting there trying not to let my jaw drop. So the advice isn't even about the stock's potential. It's about keeping the firm's business relationship intact. And the clients? They're just following along thinking they're getting insider insights when really they're just the last to know. It's like someone telling you to buy beachfront property, but not mentioning that the beach is eroding. Hey, ouch. This kind of stuff is why so many retail investors feel like they're spinning their wheels. You're playing by the rules, trying to make smart moves, but the whole system is tilted towards those with insider access and a whole lot of leverage. I mean, the amount of times I've seen regular folks get burned because they trusted some expert advice, it's maddening. I had a client once, a good guy, hardworking, who followed one of those hyped up recommendations. And when the stock tanked, he was out thousands. He called me, frustrated, saying, I thought these guys were supposed to know what they're doing. And all I could say was, yeah, that's what they want you to think. All right, so what's the play here? How do you navigate this minefield when the deck's stacked against you? Well, first things first. Cut through the noise. Don't chase every hot tip or must-buy stock you hear about on TV or from some overeager broker. Focus on the basics. Low-cost index funds, a few high-conviction stocks in growth sectors, and keep your fees as low as humanly possible. That's your foundation. Next, if you want to dabble in more aggressive plays, do it with your eyes wide open. Understand that the game is skewed. And don't throw in money you can't afford to lose. You got to treat these moves like you're going to Vegas. Have a strategy, but be ready to walk away if the cards don't fall your way. And please, for the love of all things financial, reinvest those dividends. Let them compound. Let them grow. It's not flashy, but it's how real wealth is built over time. Oh, and here's a little tip I learned from a buddy who managed to turn a small investment into a pretty sizable nest egg. Keep an eye on insider trades. No, seriously. Executives have to report when they buy or sell their own company's stock. And those reports are public. If the CEO is buying up shares like there's no tomorrow, that's a pretty good sign. They know something good is on the horizon. It's not foolproof, but it's a hell of a lot more reliable than some analyst who's just trying to make his quarterly bonus. All right, so now that we've peeled back a few layers on the market's underbelly, let's get even more tactical. I'm going to walk you through some of the exact steps I've seen work for regular folks. Yeah, the ones not riding around in limos or lunching at the top of skyscrapers. I'm talking about how to actually get your foot in the door and make the stock market work for you, despite all the nonsense we just covered. Oh, and hey, if you're finding this useful so far, maybe leave a comment below, yeah? Let's keep this dialogue rolling. Your feedback is what makes this community tick. So let me tell you about a guy named Dave. Dave was one of my clients back in the day. A no-nonsense kind of guy, worked in construction, knew the value of a hard day's work. He wasn't rolling in dough, but he was disciplined. Dave comes to me and says, I've been putting money in this mutual fund for years, and I feel like I'm treading water. I see all these stories about people making bank in the market, and I'm just not seeing it. What's the deal? We sat down and took a hard look at his portfolio. Turns out, he was spread across half a dozen funds, all actively managed, with fees that would make your eyes water, like 1.5% to 2% annually. And here's the kicker. Most of these funds were underperforming the S&P 500 by a mile. Basically, he was paying top dollar for below average results. So I said to him, Dave, you're working your butt off, saving diligently, but your money isn't working nearly as hard as you are. First thing I had him do, cut the fat. We rolled over the majority of his investments into a simple, low-cost S&P 500 index fund with fees of like 0.03%. I told him, look, this isn't sexy, but it's effective. You're going to cut your costs by 90%. And this fund's going to match the market. No gimmicks, no fancy plays, just straight up compounding on America's biggest companies. Within a year, Dave's returns had already outpaced what he'd been getting before, and he calls me up, half joking, why the hell didn't I do this sooner? We had a good laugh, but it was a serious lesson. Sometimes the best moves are the simplest ones. Now Dave didn't stop there. He was hungry for more. So we started talking about adding some spice to that portfolio. Just a little, not the whole enchilada, all right? I showed him how to identify high-growth sectors that were poised for big moves. Think tech, clean energy, biotech, the industries that are going to drive the future. But we didn't just pick random stocks because they were buzzing on social media. Nope, we dug in, looked at companies with strong fundamentals, solid leadership, and, most importantly, real potential to disrupt their markets. One of the picks we settled on was a small-cap tech company that was making waves in AI. I said, Dave, this one's a bit of a wild card. We're not putting your retirement on it, just a small piece. But this is where the upside is. He got it. He was in for the long haul. Fast forward a few years, and that stock had doubled, then tripled. Dave didn't cash out at the first sign of profit. Nope. He stuck to the plan, let it ride, and reinvested the gains. That's compounding for you, working its magic right there. See, it's not about picking winners every time. Nobody does that, not even the so-called gurus on Wall Street. It's about having a solid base, and then taking calculated risks with a small portion of your portfolio. That's how you turn the tables, even when the game feels rigged. And if this is clicking for you, why not hit that subscribe button? We're dropping gems like this all the time on Future-Proof Finance, and I'd hate for you to miss out. Now there's another thing I want to stress, and it's about keeping your eyes open to those insider trades I mentioned before. Look, this isn't some shady back alley tactic. Insiders, executives, board members have to disclose when they buy or sell their own company's stock, and you better believe those moves can be a gold mine of information. I had a client who got pretty savvy with this. She was a school teacher, smart as a whip, and she took a real interest in tracking these insider moves. One day, she spots a flurry of buys from the C-suite at a small biotech firm. We're talking the CEO, CFO, and a couple of directors all buying significant chunks of stock in a short period. She does her homework, finds out they've got a new drug in the pipeline that's looking promising. She takes a calculated position. Nothing crazy, but enough to make a difference. A few months later, the FDA approves the drug, and boom, the stock pops. She's calling me, thrilled. I can't believe it actually worked. Yeah, it does work. If you're paying attention, and you've got the guts to act when the signs are there. So, what's the takeaway here? It's all about knowing where to look and being willing to step out of the herd. The average investor is pretty much going along with whatever their broker tells them, or they're stuck in some outdated strategy that was maybe good 20 years ago. But you're not average, are you? You're here, you're learning, and that already puts you ahead of the game. I remember another client, Julia, who had this safe 60-40 portfolio. 60% stocks, 40% bonds. Standard stuff, right? But here's the kicker. Over the years, inflation was eating up any gains she was making on the bonds, and her stock picks were all the slow and steady types. I said, Julia, if you keep doing this, you're going to be just as broke 10 years from now, but with maybe a slightly nicer couch. We shifted her strategy, bumped her stock allocation up to 80%, but more importantly, we started layering in some high-growth plays. One of the moves we made was into clean energy ETFs. I'm talking solar, wind, battery tech, the whole shebang. This was around the time when climate action was picking up steam, and governments were starting to throw money at green initiatives. It wasn't a huge bet, just enough to give her some exposure. A couple of years down the line, those investments had outperformed her traditional picks by a wide margin. She was ecstatic, and she had this moment of clarity, saying, I always thought investing was about being safe, but this feels like, actually growing my money. That's what it's all about. You gotta strike a balance between safety and opportunity. Sure, keep a chunk of your portfolio in the reliable stuff, index funds, blue chips, but don't be afraid to allocate a slice to where the real growth is happening. And hey, if this is making sense to you, go ahead and share this with someone who needs a wake-up call. Most people are stuck on autopilot, and a little nudge can go a long way. And look, I get it. None of this is a sure thing. The market's unpredictable. There's risk. And not every bet is going to pay off. But sitting on the sidelines, playing it ultra safe, that's a guaranteed way to watch your wealth just kind of fizzle. You gotta be in it to win it, but you gotta be smart about how you play the game. All right, so now that we've covered some foundational strategies and a few success stories, let's dig even deeper into the meat of how to truly get ahead in this market, especially when it feels like you're starting from behind. So I want to tell you about a time when I was managing a small family fund, just a modest sum, not the big corporate stuff. This was right after the 2008 financial crisis. And everyone was, licking their wounds, playing it safe. But not this one client of mine. Let's call him Tony. Now, Tony, he was this scrappy entrepreneur type, ran a chain of auto shops, knew how to hustle. He comes to me and says, look, everyone's scared, but I want to go all in. Where's the opportunity? Now, most people were running to the safest investments they could find. Government bonds, stable blue chip stocks, all that. But Tony, he saw the crisis as a buying opportunity, so we started scouting for distressed assets. Things that were getting hammered, not because they were bad investments, but because the whole market was spooked. We found this one tech stock. It was a software company with solid fundamentals, but their stock had been obliterated because they were lumped in with all the other tech casualties. Tony takes a deep breath, looks at me and says, screw it, let's put a chunk of the fund into this. And this is where the strategy part really kicks in. Tony didn't just throw his money in and hope. Nope, he kept a war chest on the side, ready to average down if the stock dropped further. We're talking about dollar cost averaging, but with a tactical edge, buying more as it dipped, but only when the fundamentals still looked sound. And guess what? That stock bounced back, and then some, tripling within 2 years. Tony's sitting on a fat profit, and he's laughing, saying, people say buy low, sell high, but nobody's got the guts to buy low when it's scary. Ha, he nailed it. So here's the takeaway. In times of market panic, there's opportunity, if you've got the nerve and the patience. The trick is to do your homework, know what you're investing in, and have a plan to scale in slowly rather than betting the farm all at once. It's not about catching a falling knife. It's about catching the ones that are likely to bounce. And speaking of strategy, let's talk about another advanced move, options trading. Now, before you get all wide-eyed and think I'm talking about gambling, hear me out. I'm not saying you should go all in on risky options plays with your rent money, but there are strategic ways to use options that can actually reduce your risk while giving you leverage. I had another client, Sarah, who started with just a small portfolio, nothing crazy, just trying to grow her savings a bit faster than a typical savings account would allow. We started by selling covered calls on her existing stock holdings. It's a conservative strategy where you sell the right for someone else to buy your stock at a higher price in the future. You collect a premium up front, and if the stock doesn't hit that price, you keep the premium and your stock. If it does hit, you sell at a profit. It's win-win if you do it right. Sarah loved it because it was a way to generate income from stocks that were just sitting in her account otherwise. I remember her first time pulling in a few $100 just from premiums. She calls me and goes, "This is like getting paid to do nothing." Ha! Yeah, it kinda is, but it's not just about making extra cash. Options can also be used to hedge against downside risk. Let's say you're holding a stock that's been on a tear, but you're nervous about a potential pullback. You can buy a put option, which gives you the right to sell that stock at a set price, no matter how far it falls. It's like buying insurance. Now, I had this one guy, let's call him Marcus, who was deep in tech stocks, and when the market got choppy, he started losing sleep. I suggested he buy some puts as a hedge. And wouldn't you know it, when the market dipped, those puts saved his portfolio from getting completely clobbered. I get it. Options can seem intimidating. There's all this jargon, all these moving parts. But the point is, when used correctly, they can be a powerful tool in your investment arsenal. You don't have to dive in headfirst. Start small, learn the ropes, and use them to enhance your strategy rather than replacing it. The name of the game is risk management, getting upside exposure while protecting your downside. And hey, if you're curious about diving deeper into options, let me know in the comments, and I can make a whole session breaking it down. Now let's pivot to another crucial part of investing that often gets overlooked: tax efficiency. Yeah, I know. Taxes aren't exactly thrilling, but trust me, it's a game changer. I remember working with a couple mid-40s, decent income, but they were bleeding money on taxes every year because they didn't know how to manage their investments properly. They were holding their highest growth stocks in taxable accounts and constantly trading, which triggered a bunch of short-term capital gains taxes. I told them, guys, you're handing Uncle Sam a bigger piece of your pie than you need to. We shifted their strategy to prioritize holding long-term growth assets in tax-advantaged accounts like Roth IRAs and 401ks, where gains can grow tax-free or tax-deferred. And for their taxable accounts, we focused on holding dividend stocks and ETFs that paid qualified dividends. Those get taxed at a lower rate than regular income. We also took advantage of tax loss harvesting, selling losing positions to offset gains elsewhere. It's not glamorous, but let me tell you, those tweaks saved them thousands every year. They were ecstatic, and they didn't even have to change their investment strategy that much. Just a few smart moves on the tax front. Look, the government's already taking a bite out of your paycheck. Don't let them take more from your investments than they need to. This isn't about dodging taxes. It's about being smart and using every legal advantage available. If you're nodding along and thinking, man, I need to look at my tax game, you're already ahead of the pack. And if you're liking this breakdown, make sure to stick around, because we're only halfway through and there's plenty more to cover. Alright, another area that's crucial for anyone really trying to build wealth: diversifying income streams. Let me tell you about Alex, a software developer who was making decent money at his job, but wanted to invest more aggressively. He came to me saying, I'm maxing out my 401k. I'm in a good spot, but I want to do more. How do I invest without, putting all my eggs in one basket? So we got creative. First, we looked at dividend stocks and REITs, real estate investment trusts, as a way to generate passive income. I told him, think of dividends like your paycheck, but one that keeps growing if you pick the right companies. He was skeptical at first, but after a few months, when those dividends started rolling in consistently, he was hooked. Next, we explored peer-to-peer lending, small loans to individuals or businesses, where he could earn interest. Sure, it's a bit riskier, but by spreading his investments across many small loans, he minimized his risk. And then we moved on to the big one: real estate crowdfunding. You don't need to buy whole properties anymore to get into real estate. With just a few $1,000s, Alex was able to invest in real estate deals through crowdfunding platforms, getting a slice of rental income and appreciation. I remember him texting me the first time he got a distribution check from one of these deals. He was over the moon. It wasn't a huge amount, but it was diversified, and that's what made it so powerful. The point is, the more income streams you have, the less you rely on any single one. If the stock market has a bad year, your dividends, real estate income, or even your peer-to-peer loans can help cushion the blow. It's all about creating a financial ecosystem that feeds into itself, compounding your growth from from multiple angles. And hey, if you've made it this far and you're feeling pumped about building your wealth from different sources, share this video. You never know who needs that light bulb moment to get them started. So here's where we're at. Diversify strategically, think outside the box, and always be looking for new ways to grow your wealth. There's no one-size-fits-all answer, but the more tools you have in your toolkit, the better prepared you are for whatever the market throws at you. All right, let's now tackle one of the biggest myths that trips up so many investors: timing the market. I've seen this play out so many times, and it's almost comical how often people get this wrong, even the so-called pros. But hey, before we dive in, if you're getting value out of this, why not make sure you're subscribed? We've got a lot more insights coming your way here on Future-Proof Finance. So, let me take you back to the late 90s, dot-com bubble era. I was working with this big shot trader, we'll call him Jim, who fancied himself a market timing wizard. Jim was one of those guys who always had a gut feeling about the market's next move. You know the type. Every dip was a buying opportunity. Every peak was a sign to sell. So, we're riding high in the dot-com frenzy, and Jim's calling trades left and right, trying to catch every wave. But here's the thing. No one knew when the bubble was going to burst. Not even the experts. One day, Jim decides to sell off a huge position in a tech stock that was soaring, convinced it had hit its peak. He's strutting around the office like a peacock saying, "See, I called it." And for a few days, it seemed like he was right. But then that stock doubled in the next month, and Jim's sitting there, staring at the screen, trying to figure out what went wrong. The whole office was buzzing, and you could feel the tension. He made a good move, sure, but missed out on the bigger picture because he was too focused on catching the perfect top. The lesson here? Timing the market is a fool's game. Even the best, with all the data and all the resources, get it wrong more often than they get it right. And for every win, there are a dozen times they miss out or lose big because they overestimated their ability to predict short-term movements. The real power play? Time in the market, not timing the market. That's where you make your money, by staying invested and letting compound growth work its magic. Let's get concrete with a real-life example. If you had invested in the S&P 500 and missed just the 10 best days in the market over the last 20 years, your returns would be cut in half. Yeah, you heard that right. Half. And it's even worse if you miss the 20 best days. Markets move fast, and the biggest gains often come right after the biggest losses. So, if you panic sell during a dip, you're likely to miss the bounce that follows. I had this other client, Paul, who got spooked during the 2008 crash. He pulled everything out, and even when things started to recover, he kept waiting for the right time to get back in. By the time Paul felt confident enough to re-enter, he'd already missed the first 50% of the recovery. I remember him coming into my office, looking stressed, and saying, "I thought I was being smart." Yeah, Paul, so did everyone else. Timing the market isn't just hard, it's damn near impossible. I told him, look, you gotta commit to the long haul, keep investing through the ups and downs, and not let the daily noise sway you. He got back in eventually, but the emotional toll and lost gains were a tough pill to swallow. So what's the actionable advice here? Set up a consistent investment plan, like dollar cost averaging, and stick to it, rain or shine. Put in the same amount every month, regardless of what the market's doing. This way, you're buying more when prices are low and less when they're high, averaging out your cost over time. It's not glamorous, but it works. And the best part? You don't have to stress over timing every little market movement. Just set it, forget it, and let time do the heavy lifting. Another tactic I've seen work wonders, especially for those who are jittery about market timing, is the core and satellite approach. Let me tell you about Maria, a client who was just dipping her toes into investing. She was super cautious, didn't want to lose her hard-earned savings on some risky bet. So we set her up with a core portfolio of low-cost index funds. Think S&P 500, total market index, maybe a bit of international exposure. That was her core, the steady, dependable part of her portfolio that she didn't need to touch. But Maria also wanted a little excitement, a chance to, swing for the fences without putting everything on the line. That's where the satellite part comes in. We allocated a small portion, about 10% of her portfolio, to individual stocks in high-growth sectors like tech and clean energy. She got to pick a few stocks she was passionate about, companies she believed in, and it gave her a sense of control and engagement without derailing her overall strategy. I remember her calling me up, excited, because one of her satellite picks had jumped 30% in a month. She's like, "This is fun." And I just laughed, saying, "Yeah, and it's not risking your whole future, so you can actually enjoy it." That's the beauty of the core and satellite approach. It lets you have some fun and chase higher returns without jeopardizing your financial foundation. But even with this strategy, we stuck to the principle of staying invested. The core holdings were never touched, and the satellite picks were made with the understanding that they were longer-term plays, not short-term flips. We agreed on one rule: no selling unless something fundamentally changed with the company or the sector. It's like having your cake and eating it too. Steady growth with a side of excitement. Now, if you're thinking, well, that sounds great, but I don't have the time or the knowledge to pick these satellite investments, don't sweat it. There are sector-specific ETFs that can serve as your satellite picks, giving you targeted exposure without the need to deep dive into individual companies. Think of them as your all-in-one packages for high-growth sectors: tech, biotech, renewables. And hey, if you're feeling overwhelmed or you're not sure where to start, drop a comment below. We can dive deeper into the specifics, and I'm happy to guide you through it. All right, another quick tip that served my clients well over the years: automatic rebalancing. You set your portfolio to rebalance itself periodically, say once a year. This means your investments automatically adjust back to your target allocation. If one part of your portfolio has grown too much or shrunk too little, rebalancing keeps it in check, ensuring you're not overexposed to any one asset class. I had a client, Linda, who didn't rebalance her portfolio for years, and she ended up with way too much in tech right before the 2001 crash. Ouch. If she'd had an automatic rebalancing plan, she could have locked in some gains and reduced her risk. But, hindsight's 2020. Look, the bottom line is this: investing isn't about heroics or trying to outsmart the market with every move. It's about having a plan, sticking to it, and making small, consistent adjustments along the way. The market's going to do what the market's going to do. There's ups, downs, sideways moves, and plenty of noise in between. But if you stay disciplined, keep your emotions in check, and focus on the long term, you'll come out ahead. And hey, if you found any of this helpful, why not share it? There's a lot of noise out there, and sometimes people just need a steady voice to cut through it. We're building a community here at Future-Proof Finance, and every share helps someone else take control of their financial journey. All right, now, let's get into something that doesn't get talked about nearly enough, but honestly, it's probably the most critical piece of this whole investing puzzle: mindset. Yeah, I know it sounds like some woo-woo, self-help stuff, but trust me, having the right mindset can make or break your financial journey. So let's dig into the mental side of investing, and if you're vibing with what I'm saying, go ahead and hit that subscribe button. We're all about keeping it real here at Future-Proof Finance. So, let's rewind to a rough period back in 2008. I remember it like it was yesterday. Markets tanking, people panicking, calls coming in non-stop. I was managing a mix of clients, some seasoned investors who'd seen downturns before, and some newbies who were seeing their portfolios bleed red for the first time. One of these newer clients, let's call him Tim, was losing his mind. He calls me up, voice shaking, and says, "I can't handle this. I'm pulling everything out." Now, Tim wasn't alone. That was the vibe everywhere. It was like watching a slow-motion train wreck. And I get it. When your hard-earned money is vanishing in front of your eyes, the impulse is to just bail and cut your losses. But here's the thing: those who panicked and pulled out near the bottom, they locked in their losses. Meanwhile, those who stayed the course, yeah, they had to stomach a whole lot of pain. But when the recovery came, and it always comes, those folks were made whole, and then some. I had another client, Sarah. She was calm as a cucumber during the crash. She had a clear plan, knew her risk tolerance, and most importantly, She knew that the market's ups and downs were just part of the game. She didn't flinch, didn't panic, and even found the guts to buy more during the dip. 3 years later, her portfolio was back, and then some, while Tim, well, he sat on the sidelines and missed the bulk of the recovery. It's a cliche for a reason. Investing is as much about managing your emotions as it is about managing your money. And if you can't control your emotions, you're toast. It's like trying to steer a ship in a storm without a compass. So, how do you keep your head when everyone else is losing theirs? Well, it starts with understanding your own psychology. What makes you tick, what keeps you up at night, and what your true risk tolerance is. I had another client, Julia, who I mentioned earlier. She's the one who had the 60/40th portfolio and was playing it safe, right? Well, part of that was because she was super risk averse. She'd get anxious if her portfolio dropped even a little. So instead of pushing her into a more aggressive strategy she wasn't comfortable with, we did a deep dive into her goals, her fears, and how much she was truly willing to risk. We found a balance that allowed her to sleep at night, but still gave her portfolio the growth it needed to keep up with inflation. And here's a real tip that can help keep those emotions in check. Set rules for yourself. No, seriously, have a checklist or a set of guidelines you stick to no matter what. Like, don't look at your portfolio more than once a month, or commit to never selling unless a stock drops more than, say, 20%. Whatever helps you keep the knee-jerk reactions at bay. It's a small thing, but having rules can be a lifesaver when the market gets choppy. I once had a guy, Dan, who was notorious for logging into his account multiple times a day, watching every little tick up and down. He'd call me all the time, freaking out about every little dip. I finally said, Dan, you've got to stop. You're driving yourself crazy. We set a rule. He could only check his investments on the first of each month. And wouldn't you know it, his stress levels dropped. And so did his impulse to sell every time the market sneezed. By stepping back, he could see the forest for the trees. And his portfolio performance improved just because he wasn't overreacting all the time. And here's another nugget of wisdom. Build yourself a financial cushion. It sounds basic, but you'd be amazed how many people skip this step. Having a solid emergency fund in place means you're not forced to sell your investments when things go south. I've seen it too many times. Someone loses their job, or they get hit with a big unexpected expense, and suddenly they're cashing out their 401k or selling stocks at the worst possible time. If you've got 6 months or more of expenses stashed away in cash, you're going to be in a much better place mentally. You won't feel the need to liquidate your investments at a loss just to cover your bills. Let me tell you about Carla. She was a single mom, had a good job, but wasn't making bank by any means. She started building her emergency fund a little at a time. $50 here, $100 there. Slowly but surely, she got it up to a full 6 months worth of expenses. Then, when the market took a hit, she wasn't stressed. She knew she had her safety net, so her investment accounts stayed put. And when the market bounced back, she was still in the game, smiling, because she didn't have to sell a thing. Here's the thing. Fear and greed drive the market, but they shouldn't drive you. Having that buffer, both financial and emotional, can make all the difference. It's about keeping perspective. The market's going to go up and down, but over time, it trends upward. If you can zoom out and see the big picture, you're less likely to make costly mistakes. Oh, and here's a little strategy I use myself. Every time the market tanks, I treat it like a sale. You wouldn't go into a store, see a 30% off sign, and think, oh no, I'd better not buy anything. You'd be thrilled. It's the same with stocks. When prices drop, good companies are on sale. If you've done your homework and know the companies are solid, downturns are just buying opportunities. I once picked up shares of a major tech company during a market slump. Everyone was panicking. Headlines were doom and gloom, but the fundamentals hadn't changed. I bought in, and a few years later, those shares had tripled. I had friends saying, man, I wish I'd had the guts to buy when you did. But it wasn't guts. It was planning. I knew what I was buying, and I knew it was a good deal. So if you're still with me, take this as your cue. The next time the market takes a nosedive, take a breath, stick to your rules, and look for those opportunities. Don't let fear drive your decisions. It's all about the long game. So far, we've now covered stocks, mindset, and the importance of sticking to your plan. But now it's time to talk about expanding your horizons beyond the stock market. See, putting all your eggs in one basket, even if that basket is full of great stocks, isn't the only way to grow your wealth. In fact, some of the most successful investors I've worked with didn't just rely on the stock market. They branched out into alternative investments that helped them diversify and build multiple streams of income. So let me tell you about Rebecca. She was a dentist, good income, smart with her money, and very diligent about saving and investing. But Rebecca wasn't satisfied with just putting her money into mutual funds and letting it ride. She wanted more control and more ways to grow her wealth outside of the ups and downs of the stock market. So we started exploring alternative investments. And one of the first things we looked at was real estate. Now I know, real estate sounds intimidating. You hear about needing huge down payments, dealing with tenants and all that hassle. But here's the thing. You don't have to go it alone, and you don't have to start with a full-on property purchase. Rebecca started small by investing in real estate crowdfunding platforms. These platforms let you pool your money with other investors to buy into large real estate projects. Think apartment buildings, commercial spaces, even new developments. You get a share of the rental income and potential appreciation without having to manage a single tenant. Rebecca put about $10,000 into a diversified real estate crowdfunding deal that focused on multifamily units in up-and-coming areas. It wasn't a huge amount, but it gave her exposure to the real estate market without needing to be a landlord. Within the first year, she started seeing quarterly distributions from the rental income. It wasn't a windfall, but it was steady and growing, and she was thrilled to have a new income stream that wasn't tied to the stock market's daily roller coaster. And you know what? After seeing those returns, Rebecca felt more confident to take on a larger role in real estate. She eventually bought her first rental property, a small duplex. It wasn't all smooth sailing. There were some hiccups with tenants and maintenance, but the cash flow was solid. And over time, the property appreciated nicely. By diversifying into real estate, Rebecca was able to create a new income stream and grow her net worth outside of her 9-to-5 and her stock portfolio. She even got to the point where she was thinking, hey, maybe I could cut back on my hours at the dental practice. That's the kind of freedom diversifying can bring. Now, if real estate feels too big or risky, there are other ways to diversify beyond traditional stocks and bonds. Let me tell you about Sam, an engineer who came to me looking to expand his investment horizons. He wasn't interested in real estate, didn't want to deal with the headaches of property management, but he was intrigued by the idea of peer-to-peer lending. Yeah, you heard that right. Sam started investing in small loans through peer-to-peer platforms, lending money to individuals and small businesses who needed quick capital. The returns? Not bad at all. We're talking 5 to 8% annually, sometimes more, if he was willing to take on a bit more risk. The key here was diversification. Sam didn't put all his money into a single loan. He spread it across dozens, even hundreds, of small loans. So if one or two defaulted, it wouldn't sink his whole ship. It was a great way to generate passive income with a bit of a different twist. And Sam? He loved the fact that his money was helping people launch businesses, pay off debts, and get back on their feet. It was investing with a purpose, and that gave him an extra sense of satisfaction. Then there's precious metals, gold, silver, and even some of the newer kids on the block, like platinum and palladium. I had a client, George, who swore by gold. Now, I'm not saying you should go all in on shiny rocks, but having a small portion of your portfolio in precious metals can be a solid hedge against inflation and market volatility. George used to say, gold is the one thing that's been valuable for thousands of years. It doesn't care about earnings reports or interest rates. And he's got a point. When markets get shaky, gold often holds its value or even goes up, providing a nice buffer against stock downturns. George started by buying small amounts of physical gold, coins, bars, you name it. He'd stash them in a safe, and over the years, that little hoard grew nicely in value, especially during market downturns. He even dabbled in gold ETFs for easier liquidity. Now, George isn't living off his gold or anything. but he sleeps a little better knowing he's got a tangible, historical store of value in his portfolio. It's all about balance and having a mix of assets that perform differently under various market conditions. And then, of course, there's the digital frontier, cryptocurrencies. I know, this one's a wild ride. I remember a client named Nate who got in early on Bitcoin. This was back when it was trading for just a few $100. Nate was a techie, always on the cutting edge, and he saw potential where others saw a fad. He threw in a few $1,000. Not a crazy amount, but enough to feel the rush. Fast forward to today, and let's just say Nate's done all right for himself. But here's the key. Nate didn't throw everything into crypto. He saw it as a high-risk, high-reward play, and only invested what he could afford to lose. Nate's story is a reminder that alternative investments, especially something as volatile as crypto, should be a small slice of your overall pie. I've seen others get burned by going all in, so tread carefully, do your homework, and never invest more than you're comfortable losing. But for Nate, that small speculative bet paid off in a big way. And hey, even if you're not looking to get into Bitcoin or Ethereum, just keeping an eye on the digital asset space can open up new avenues of thought and opportunity. So what's the action plan here? Start by looking at your portfolio and identifying where you might be overly reliant on one asset class, like stocks. Ask yourself, what can I add that will move differently when the market moves? Whether it's real estate, peer-to-peer lending, precious metals, or even a sprinkle of crypto, the goal is to create a financial ecosystem where your assets complement each other. And don't feel like you need to dive headfirst into something new. Start small, learn the ropes, and build up from there. Even a few $100 invested wisely in a new asset class can teach you a lot and set the stage for bigger moves down the road. We've been on quite the journey. Stocks, mindset, alternative investments, and more. But now, let's talk about the ultimate goal. Financial independence. I mean, what's the point of all this investing, saving, and strategizing if not to get to a place where your money works for you and not the other way around? So let's dig into how to really achieve that freedom. And hey, if you've stuck with me this far and you're getting some solid nuggets out of this, maybe consider sharing this with someone else who's on their own financial journey. We're all in this together at Future Proof Finance, and it's all about helping each other get ahead. So financial independence, it's that magic point where your investments and passive income cover your living expenses. You're no longer chained to a paycheck or reliant on the daily grind to keep your head above water. And trust me, I've seen people from all walks of life make it happen. But it takes a blend of discipline, smart planning, and, a bit of patience. Let me tell you about Lisa. Lisa was a nurse, working long shifts, and while she loved her job, the burnout was real. She came to me saying, "I'm tired of working until I drop. I want to retire early, but I have no idea if that's even possible." Now, Lisa wasn't earning six figures or anything, but she was smart with her spending and saving. So we mapped out a game plan. The first step was laser focusing on her savings rate. We bumped it up to 30% of her income, which wasn't easy, but Lisa was committed. She cut down on non-essentials, negotiated bills, and even took on a side gig for a while to boost her contributions. All those little changes added up, and before long, she was maxing out her retirement accounts and still socking away extra into a taxable investment account. We also worked on building multiple income streams. Remember those alternative investments we talked about? Lisa got into real estate crowdfunding, similar to Rebecca's story, and started seeing small, steady returns from that. She also bought a couple of dividend-paying stocks. Nothing flashy, just good, solid companies that had been paying dividends for decades. Her goal was simple: build a portfolio that could replace her salary with passive income. And here's where it gets really interesting. Lisa didn't just save and invest. She kept track of her financial independence number, the amount of money she needed to generate enough income to cover her expenses without touching the principal. It's usually about 25 times your annual expenses, using something called the 4% rule. So if you need $40,000 a year to live comfortably, you'd aim for a nest egg of around $1 million. Lisa hit that number faster than she thought possible because she stayed consistent, avoided lifestyle inflation, and stayed focused on her goal. The day she hit her target, I got this call from her. She was at work, on her break, and she's like, I did it. I don't have to be here if I don't want to be. She wasn't retiring the next day or anything, but knowing she had the option, that's freedom. She kept working for a bit, but on her terms, and with way less stress. That's what financial independence buys you. The freedom to choose. And you better believe Lisa's still investing, still growing her wealth. Because why stop now? Now you might be thinking, that's great for Lisa, but I'm not there yet. And that's fine. Everyone starts somewhere. And the important thing is to start moving in the right direction. The key steps? Increase your savings rate, invest consistently, and don't let lifestyle creep eat away at your progress. Keep your expenses low relative to your income, and you'll be amazed at how fast you can build wealth. Another crucial piece is having a rock-solid budget. I know. Nobody likes the word budget. It sounds restrictive, like a diet for your wallet. But a budget isn't about deprivation. It's about priorities. It's about making sure your money goes toward what truly matters to you, whether that's investments, travel, or even the occasional splurge. I had a client, Martin, who was always scrambling with his finances, never sure where his money went each month. We sat down, built him a budget, and within 6 months, he was saving more than he ever thought possible, just because he got intentional with his spending. And look, financial independence doesn't mean you have to stop working if you don't want to. I know people who hit their number, but keep working because they enjoy it. It's not about quitting your job the second you can. It's about having the choice. It's about waking up in the morning and knowing that you're working because you want to, not because you have to. That's powerful. Here's another quick story for you. Jenna, a school teacher, started a small side business tutoring kids online. It started as just a way to make a little extra cash, but she scaled it up, built a client base, and eventually, her tutoring income matched her teaching salary. Jenna kept investing her side hustle money and ended up hitting her financial independence number without even realizing it. One day she did the math and was like, wait a second, I don't actually need to keep my full-time job. So she transitioned to tutoring full-time, doing what she loves, and making her own hours. That's what financial independence looked like for her. Freedom from the traditional 9-to-5 grind, doing something she was passionate about. And remember, financial independence isn't just for high earners or Wall Street wizards. It's for anyone willing to plan, save, and invest wisely. It's about building habits, making smart choices, and being consistent. It's about playing the long game and not getting distracted by every shiny object along the way. One of the most powerful things you can do is to automate your investments. Set it and forget it. I've had clients who were so overwhelmed with managing their finances that they just wouldn't do anything at all. Total analysis paralysis. By automating their contributions, whether it's to a 401k, IRA, brokerage account, whatever, they took the decision-making out of it. It's amazing how much progress you can make when your money just does what it's supposed to, month in and month out, without you having to think about it. All right, let's pull this all together. If you want to reach financial independence, here's your roadmap. 1. Save aggressively. Aim to save at least 20 to 30% of your income, more if you can. This isn't about penny pinching. It's about prioritizing your future freedom over today's fleeting comforts. 2. Invest consistently. Automate your investments, diversify beyond just stocks, and think long-term. Let compound interest do the heavy lifting. 3. Minimize debt. High-interest debt is your enemy. Pay it down aggressively and keep it in check. Debt can be a tool, but it can also be a trap. Know the difference. 4. Live below your means. This doesn't mean living like a monk. It means being intentional about your spending. It's okay to enjoy your money. Just do it in a way that aligns with your financial goals. 5. Build multiple streams of income. Whether it's side hustles, investments, or passive income streams, the more ways you have money coming in, the less reliant you are on any one source. 6. Track your progress. Know your numbers. Track your net worth, your savings rate, and how close you are to your financial independence number. What gets measured gets managed. 7. Stay the course. There will be bumps, setbacks, and maybe even some mistakes along the way. That's normal. The key is to keep moving forward, adjusting as needed, but never losing sight of your ultimate goal. So there you have it. Financial independence isn't a pipe dream. It's a plan, and it's totally within reach if you're willing to take the steps and put in the work. Thanks for sticking with me through this deep dive. If you found this series helpful, do me a favor. Hit that like button, subscribe if you haven't already, and share this with someone who needs to hear it. We're all about building wealth, creating freedom, and helping you future-proof your finances.